I predict that we're going to see affordability deteriorate in most capital cities this year.
In the data, are regional markets still outperforming capitals in terms of growth and demand?
The price rises for rental properties has slowed.
We're not even 8 weeks into 2026 and already the property market is giving us lots to talk about. Last year, we saw 3 interest rate cuts, easing inflation pressures and a slight lift in housing stock. But in 2026, we've already been hit with another rate rise this month. So housing affordability and a challenged market is going to be a very hot topic. Here with me to break down just how this year might play out is senior economist Anne Flaherty and property journalist Dan Butkovich, both my colleagues at REA Group. And let's kick things off with property prices and interest rates. Now, what is the RBA signalling with interest rates this year?
Well, if we start with the different markets around Australia and how they performed, we have continued to see that divergence. So markets like Brisbane, Adelaide, Perth saw very strong price gains. That was really the result of limited stock for sale in those markets. In contrast, places like Melbourne and Sydney, we actually saw a real slowdown in the rate of price growth. And those were also markets where there was a lot of properties for sale. So buyers had more choice. Interest rates are really going to be the big one. 3 rate cuts last year helped to bolster that demand, that price growth. Now we've had 1 interest rate rise with the potential for further rises if inflation sticks around. And that's probably going to slow the pace of growth this year. There are other factors at play, of course, though, supply and demand, the 5% home deposit scheme. We've seen an uplift in investor demand over the past 12 months. So there's still some pretty strong demand out there. And it'll be interesting actually to see what the impact of the rate rise is going to be on the market with that stronger demand still in place.
Well, I would really love to know that. Like at a basic level, what impact does an increase in interest rates have on the property market?
All else equal, higher interest rates typically decrease property prices. That's because it's more expensive to borrow. We also see sometimes confidence takes a hit when people feel a little bit uncertain as to how far interest rates could rise and what that's going to mean for future mortgage repayments. But we know that in the Australian market, the impact of interest rates has sort of decreased over time. And the reason for that is really to do with that insufficient housing supply. People need somewhere to live. And in a sense, what that means is that they have to deal with the higher mortgage repayments.
It almost doesn't matter what the price is, does it?
Exactly. So it just means that people are forking out more of their income to pay for their housing. But obviously, interest rates definitely have an impact. It's just that how much of an impact is it when we see, very limited supply and people still competing for homes?
Dan, you're deep in the data on this. Where are we seeing the strongest price moves this year so far?
Yeah, so we're only a few weeks into the year, but we are already seeing some of the cities that had strong momentum last year carry that momentum into this year. So Perth, Adelaide and Brisbane, they've been really strong markets for quite some time now. So they've already posted some gains at the start of this year. The other one to watch would be Darwin. Prices grew there about 14% last year.
Wow.
And so it's likely that there'll be stronger growth in the year ahead.
So where are your predictions for the biggest price shifts in 2026?
Some of the smaller markets, so Darwin, but also some of the smaller regional cities, regional Victoria, we're already seeing some strong demand there. So places like Mildura, Ballarat, Bendigo, and also in regional New South Wales, places like Albury and Wagga Wagga potentially could see some strong growth there as well.
So there's a bit to watch there in terms of price. Look, one factor that's going to play a part in that is obviously demand drivers. Now, migration remained historically high in 2025. New housing supply only slightly improved. The federal government's expanded Help to Buy scheme does kick off in full from February. And do you see this having a measurable impact on buyer demand this year?
I do think there is going to be an increase in demand, particularly from first home buyers over the first half of this year. Help to Buy scheme kicking off. I think that the 5% deposit scheme is going to be the real one to watch. It's open to all first home buyers, regardless of what their income level is. And I think that we did see that increase in investor demand as well last year. And I think we're probably going to be seeing a lot of competition among both first home buyers and also investors over the first half of this year. I think that that's going to help to mitigate the effects of higher interest rates. And of course, migration, as you mentioned, it's a major factor. It's a longer term impact as well. We've seen migration strong for several years now. It has slowed down from the peak levels we were seeing around 2023, but it's still in line with those historic average levels, whereas the rate at which we're building new homes is still below those long-term average levels. So until that sort of fundamental shift in how many homes we're building versus our population growth shifts, those undersupply problems that we've been experiencing for quite a few years now are likely to persist and likely to maintain home price growth regardless of how far interest rates may increase.
Okay, so first home buyers aside, what is the demand from the upsizer and the downsizer markets? Is that something that we have any insight into and how it might affect demand?
Well, I think that people looking to upsize, we're often more likely to see people make that move in a market where interest rates are falling. So some people might be looking at their existing mortgage repayments and how much more they might have to fork out in mortgage repayments and delay that upsizer move. Downsizing is going to remain a trend. If we think about different generations in Australia, the baby boomers are equally the largest generation along with the millennials. And this is a decade that a lot of those baby boomers are retiring, looking to move to greener pastures or close to, perhaps warmer weather. So I think that, if we look at a market like Queensland, a lot of those high demand regional markets like the Sunshine Coast, the Gold Coast, Cairns are likely to still continue to see that influx of people perhaps from the other states or even Greater Brisbane. And so I think that those sort of markets are going to be more resistant to impacts from things like interest rates. We know that downsizers are often just paying cash, selling a home, paying cash for their next property.
Dan, from a news perspective, what is the sentiment amongst agents and buyers heading into this first quarter? Are you having conversations where people are optimistic about supply and demand?
Yeah, I think it's cautious optimism. We did have 3 rate cuts last year, so that has boosted sentiment. In terms of the year ahead, it depends on, I guess, the path for interest rates. But that the rate cuts last year did really support demand. We had higher listings coming on the market in Sydney and Melbourne, so that gave buyers more choice. So that's a real positive. In other cities, Perth, Brisbane and Darwin, there's been tighter supply, so that's made it more difficult for people trying to find a property. But the flip side of that is it supported price growth. So anyone looking to sell a property is presumably getting higher prices. So they're feeling pretty good about that. First home buyer interest has remained strong due to the incentives that the 5% deposit scheme that's supporting people looking to get into the market. So that's been positive there. And investor activity, has been increasing, particularly interstate investing. So people looking to invest outside of their own markets. That's an area to watch as well.
Speaking of supply challenges, this was a central theme to 2025. And while material costs have eased ever so slightly, labour shortage remains the really huge constraint. And what needs to happen for construction activity to rebound this year? And do you actually think that it will happen?
I actually think that new construction activity is going to face a few challenges this year. On the positive, we've actually seen the time it takes to build new houses and townhouses decrease over the past 12 months. That means building faster. Unfortunately, though, we've actually seen the average time to build apartments has continued to increase. We've also seen that construction costs, they're still rising. The good news is that the pace at which construction costs are rising has stabilised. But then, as you mentioned, labour shortages remain a significant issue, and particularly in light of the fact that we've got these major infrastructure projects happening around the country, that actually competes for labour with the house construction industry. And I think that a market like Brisbane, for example, that's seeing a lot of infrastructure improvement in line with the upcoming Olympics, that's a market where we have a significant shortage of properties, and the construction industry is for the homes and the house construction industry is competing with labour from a lot of those projects. Another, of course, impact on development activity is interest rates. And when we see interest rates increasing, that can add to the cost of developing new homes. So ultimately, I think that when it comes to new homes being developed, feasibility is the number one factor. So in areas where we are seeing some stronger price growth, those are the markets where we're typically seeing more development activity. In markets where home price growth has been slower, those are the places where we haven't seen as big of an increase in that new construction activity.
Dan, walk us through what the media is saying about all of this.
Yeah, so I think the media is broadly supportive of increased home construction, getting more properties built to ease that supply constraints in the market. I think where there has been a bit of skepticism is around whether government responses have been large enough to address the issue. We do have a supply deficit. There are positive things in place to get that happening, but whether that response is sort of large enough to address the issue, I think there might be a bit of skepticism there. Another aspect has been that debate around sort of fear of overdevelopment. Some people worried about higher density coming to their neighbourhood, but I think overall the increased supply for more housing is a positive thing, and I think a lot of people were really ready to embrace that.
Well, if we move on to affordability pressures, and do you predict any cities or regional markets that might actually become more stretched this year?
I predict that we're going to see affordability deteriorate in most capital cities this year, perhaps every capital city. And there's a few factors here. First of all, interest rates. Higher interest rates are going to make it more expensive for people to borrow, but we don't anticipate home price growth is going to decrease. So if people are having to pay more for a property and higher interest rates, more for that mortgage as well, that's going to impact affordability. And if we look at a lot of markets around the country, some of the areas where prices are actually sitting at the highest levels or have experienced the strongest price growth, they're not necessarily areas where the median income is particularly high relative to the national average. So there are a lot of markets around the country where we actually see very strong home price growth, high property prices, but median incomes in those areas aren't really keeping up. I think something else that factors into this is a lot of those sort of hotspot regional markets around the country where we see demand from people who are being paid a salary by perhaps a big corporate in a capital city area, but they have the flexibility of working remotely, so they can move and live in an area where perhaps the median income in that area is much lower compared to a capital city. So that can create pressures in certain markets as well.
Dan, what is being said from a news point of view in this regard? Are the areas that Anne's mentioning stack up to what's being reported, or do you have maybe something else to add?
In some of these smaller regional markets that have seen these rapid price rises, that does place pressure on locals trying to get into the market, especially if there are outside investors coming in, competing for properties that are on the market, obviously motivated by strong rental returns and the potential of strong price growth. For someone who's, looking to get into the market, even at a more affordable price range, if the price has gone up from $600,000 to $650,000 or $700,000, that's a huge amount of money that someone's going to have to then find to get into the market. And if they can't come up with that money, then they're going to have to, I guess, shift their expectations, potentially buy further out, move somewhere else. That can affect, their livelihood and things like that. So it does, create some real pressures for people. And with interest rates potentially going higher, prices going higher, it all adds up to...
It's a perfect storm.
Exactly right.
Well, look, when it comes to regions versus capitals, Dan, in the data, are regional markets still outperforming capitals in terms of growth and demand, or are we seeing a shift this year?
So in the past year, the regional markets combined went up about 9.7% compared with the capitals, which was about 8%. So there is that bit of outperformance there. There is a bit of nuance to that. So across some parts of regional Western Australia and Queensland, price growth was as high as 15 to 20% in the past year. Whereas if we look at regional New South Wales, some areas it was more like 5 or 6%. So there's a bit of differences across the market there. In terms of the strongest performing capitals, Perth, Brisbane, Adelaide and Darwin, they're between 14 and 17%, so quite strong price growth there. Whereas Sydney has been about 6.5% over the past year. Melbourne was about 3.5%. So those cities are growing a little slower. So there are some nuances to the data in terms of exactly where we're talking about.
And what is your take here? What are you predicting for the growth and the demand of our regions?
So we do think that home price growth in regional areas is likely to outpace the capital city counterparts in most states in the country. One of the reasons for that is interstate migration, that is people moving away from capital city areas into regional areas, is remaining a factor. Affordability is one of the factors, of course, driving people to look to buy a home further away from a city. Also, more flexible working practices that have persisted post-COVID. And of course, if we look at new housing supply, often in the regions, it can be actually a little more expensive to build. And a lot of regional areas are actually seeing more challenges in constructing new homes than we're seeing even in the capitals. So I think that could lead to that relatively stronger price growth, particularly in regional markets that are within around a 2-hour commute distance time from a capital city. Those are typically the ones that see the stronger price growth, the higher prices, the more demand.
Okay, well, it would be remiss of us not to discuss what has been a major talking point for a number of years, which is our rental market. It did show very tiny signs of easing last year, but vacancy rates are still sitting at record low levels in many areas. And what's your read on rental supply for 2026?
Well, I actually think that we might see conditions improve in the rental market in certain senses. While we don't really anticipate that rents are going to move dramatically backwards or anything like that and are likely to hit new highs this year, we have seen an uplift in investor activity over the past 12 months, a pretty significant rise, actually. And, for people who are not looking to buy and compete with investors, that's good news. If you're a renter, more investors means often more rental properties available. So that can help to ease those low vacancy rates. But I think as well, things like the 5% home deposit scheme might enable more people to transition away from being renters to first home buyers, and that might help to alleviate some of the low vacancy as well. Of course, it can also be the situation where the first home buyer is purchasing a property that was formerly a rental, so it can even out. But often when we do see an uplift in first home buyer activity, that can correspond to an increase in vacancy rates in the markets that they're leaving. And I think particularly a lot of inner city areas, we often see people who transition from being renters to first home buyers leave inner city areas where they're renting to buy in areas further afield.
Dan, what's the media saying about renting as a whole? Because for the last couple of years, it hasn't really been painted in the best light.
Yeah, I mean, it is still tough to be a renter. I think perhaps it has slipped out of the headlines a little bit, and that's potentially a good thing. The price rises for rental properties has slowed. So if we look at the past year, rents in the capitals went up about 3%, in the regions went up about 5%. But if we compare that to, say, 2023 or 2024, we're looking at about 15 to 20% increase in rents over the course of the year.
Wow.
So very rapid rent increases.
Yeah.
So the competition has perhaps not quite as intense as it was, but rental affordability still is at its worst level in decades. So it is quite tough out there to be a renter. Just the other day, I was walking past an inspection that had a line of about 60 or 70 people queued up to get into a rental, and only one of those people are going to end up in that property. So the competition is quite intense in some parts, especially popular areas.
Well, are there any policy changes in this space, or I guess state level moves that we should be keeping an eye on that potentially have the ability to shift rental conditions this year?
Yeah, so the reforms in New South Wales and Victoria have been the most prominent ones. So in terms of Victoria, it was around improving minimum standards for rental properties, removing no grounds evictions, and limiting rent increases to once a year. So those are really great things for renters who are facing those challenges. There has been a bit of anecdotally a bit of a reaction in the investor market. So in Victoria, there were reports of some investors seeing these changes and deciding to sell out of their investment property. But the flip side of that is there have been more investors coming into the market, perhaps not as perturbed by these things that other investors might see as burdens. So that's a great thing, having more investors come into the market and increasing rental supply, and just generally improving rental standards is a positive thing overall. I mean, the rental stock in Australia is like really important infrastructure for society. So anything that can improve the quality of life for renters is a good thing.
Absolutely. And on that investor tangent, they are a cornerstone of our rental market, so we need to be discussing them for just a minute. And what is investor demand looking like now? And where do you see it going in 2026? Because as we've touched on, it was exceptionally high last year. Do we just think that trend is going to continue?
I think that part of the reason we saw the increase in investor activity, so nationally it was up about 10% in terms of the number of new loans to investors compared to the previous year. I think that lower interest rates had a part to play there. I think a lot of investors were also looking at the fact that the government announced this 5% first deposit scheme, at least 6 months before it actually came into effect. So I think a lot of investors probably thought, well, I've got a lead time. There's going to be this wave of first home buyer demand that's going to hit the market. Maybe I should get in now before that kicks in. I think as well, even with interest rates got on the up this year, investors might be looking at the fundamentals of the market, saying the population growth is really strong. We're still seeing problems with the rate at which construction activity is occurring. Those are the two fundamental things that affect property prices in this country. There's still some pretty good scope for capital growth. Even if we don't see rents rise and yields improve, a lot of investors are looking at the capital growth that they're going to achieve in purchasing that property, more so than what's happening with rental movements. So I think that with capital growth still on the cards in most markets, that's going to continue to drive a strong demand from investors.
All right. Well, are there any major disruptors on your radar that we should be aware of?
Look, I think the level at which interest rates increase could be a major disruptor. It does impact affordability. It also impacts confidence. The government schemes around first home buyers could also be a major disruptor, particularly in those suburbs where we see a lot of homes for sale within the price thresholds that the government set for the scheme. This could drive a really significant level of price growth in our more affordable areas. We typically see stronger price growth in affordable areas anyway. So this could really exacerbate that. So I think it'll be interesting to see, how the ratio of first home buyers compared to investors really plays out over the next 6 months. I think that we're going to see a lot of competition at a certain segment of the market. It'll be interesting, I think, to see what happens at the other end of the market in the more expensive suburbs, what the impact of higher interest rates is going to be. There are certain segments of the market that are more resilient to interest rates, and that's typically the more affordable end. But having said that, of course, there are certain suburbs around the country where we see this sort of premium housing stock that can be quite resilient purely because it's very limited in supply. And so when homes in certain areas come up for sale, we can still see some relatively strong buyer competition. So again, it always comes down to the specific market you're looking at, and not just suburb-wise, but also price point-wise.
Dan, what about you? Are there any major disruptors for this year that you're keeping an eye on?
I think it's more of an ongoing trend around what we term borderless investing. So people investing outside their home state, not tied to investing in their local neighborhood. I think that trend is going to continue. I think we've seen it over the past couple of years with investor activity in places like Perth and Adelaide and now Darwin. Regional Victoria, it's happening there. And it's actually, I'm hearing reports of more interstate investors looking into Tasmania, regional Tasmania, Hobart, Launceston, places like that as well. So that's one to keep an eye on, because I think when investors can come into some of these markets, all of a sudden that can sort of disrupt the local market and potentially contribute to higher prices there. The other thing I would say is just I think investors have sort of been empowered by more access to data and understanding on what's going on in the different property markets around the country. So it's no longer about, seeing what's happening at the auction down the road. You can jump online and find out information about any suburb in Australia. And so that's really removed the friction there. The other aspect of that is the rise of buyer's agents. So people can buy a property in another state or another city without leaving their lounge room.
We have someone do the legwork for you.
Exactly right. And so I'm hearing reports from agents in some areas who have never dealt with buyer's agents before, and now they're getting calls every day. I think in one case, one agent talked about 20 or 30 calls a day from buyer's agents just looking for any property to buy, because the demand is there from investors looking to park their money somewhere.
Wow. Well, look, today certainly has been a lot to digest, and it is clear that 2026 could shape up to be very different depending on things like we've touched on interest rates, supply, migration and investors. Anne and Dan, thank you so much for joining me. I really appreciate it.
Thank you.
Thank you.
Thanks for joining me. This has been Real Talk. For your weekly fix, please follow wherever you listen to your podcasts and tune in next time for more real questions, news and insights on the topics that matter most from realestate.com.au, Australia's #1 address in property. All information provided is general information and opinion based on current market conditions. These opinions should not be treated as investment advice. Always obtain advice based on your individual circumstances.
Real Talk acknowledges the traditional custodians of country throughout Australia and their connections to land, sea, air and community. We pay our respects to elders past and present.